That's the closing bell on Wall Street, and now it's market domination overtime. We're giving you full coverage of all the moves to get you up to speed on the action from today's trade. And Yahoo Finance's Jared Blickley joins us now with the latest market action. Jared.
Thank you, Josh. The majors, not a whole lot going on today, and I'm going to show you that price action, but we do have a record high to talk about in a minute. Not going to be in the Dow here. That was down 7 basis points or 31 points. NASDAQ Composite up about 0.2, and then the S&P 500 about half of that. But as you can see from the chart behind me, whole lot of chop today, a lot of sideways trading action. But Russell 2000, first record closing high since October 27th. And you're going to notice it was a pretty decent day, up 0.7%. Meanwhile, its small cap cousin, the S&P 600, finished underwater. Difference between the two, Russell 2000 allows unprofitable companies into the mix, whereas the S&P 600 does not. And the Russell 2000 maybe got an extra boost from, I don't know, just a prospect of the first record close in about a month there. So take it how you want it. That's what happened today. And let's check out the sector action. Communication services, that's where you're going to find Alphabet and Meta. That was up 0.5%. Meta really had a nice day. We're going to take a look at them in a second. Industrials, energy, tech, financials, that rounds out the top row, and also all the green and all the outperformers from the S&P 500. And to the downside, healthcare, XLV was the worst off, down about 0.8%, followed by materials, staples, consumer discretionary. And let's take a look at that NASDAQ 100. There, NVIDIA finished up over 2%. Meta up 3%, circling that right there. Tesla up 1.5% or so, but there was a lot of red on this board here. Apple down 1.21%. That's the second day in a row that Apple has been down after that 7-day win streak. Amazon down almost 1.5 points. And then if you take a look at the semiconductors, you do see some dark red there. Intel down 7%, Micron down 3%. As I pointed out earlier, Lumentum up 9%, Western Digital up 3%, but more red than green. And then when you take a look at software, there's a lot more green than red. Oracle up 3%, so is Salesforce, and it looks like Path. That looks like an outsized winner today. That was up 24%. And let's check out, let's actually leave it on the Dow here. Besides the mega caps that we already covered and Salesforce, which is sitting there at the bottom, that's the best performing stock in the Dow. Kind of even here. I would say JP Morgan up 1.25%, IBM up almost 2%, Verizon up 1.5%. Mixed with some losers in there. All in all, I'd say it was kind of a choppy day, a lot of sector rotation, and congratulations on the Russell 2000 for that first record closing high in a while.
All right, thank you, Jared. The market's closing the day mixed, and now we're getting a fresh look at what next year could bring with Truist 2026 economic outlook. For more, we're bringing in Keith Lerner, who's Chief Investment Officer and Chief Market Strategist at Truist. Keith, it is always great to see you. So let's start here. You say the North Star of this bull market, Keith, it's profits. So maybe start there, Keith. You know, what does profit growth look like next year, Keith, and how narrow or broad is that growth?
Yeah, well, first, Josh, always great to be with you. And you're right, we just released our annual outlook, the 7th inning stretch. And to your point, the key foundation of this bull market has been profits. And we can think about the last year. There's been narratives, inflation, tariffs, back and forth. But the most important factor, the key driver of this bull market, in our view, is profits. And we're seeing as the S&P 500 is still around record highs, we're also seeing forward earning estimates for the S&P also at record highs. And then to your question, what's driving that? Well, the dominant theme of this bull market is still tech and AI. And we are seeing tech forward earning revisions by far the strongest in the market, actually double that of the overall market. But I will say that we are seeing, things boring out. We're seeing positive revisions in financials, industrials, and many other sectors as well. So it's not just tech, but that is still where the strength is within the overall market.
In terms of history here, every bull market that made it past 3, year 4 still up, gains around the mid-teens. Stocks usually do well after the Fed cuts near highs. So what do you think? Does it look like the bet would be history repeats itself?
Yeah, well, Josh, the way we, with our outlook, we have a weight of the evidence approach, and some of the stats you just mentioned from that is a historical basis. I think Warren Buffett said is if all you needed was history, the richest people would be librarians. But I think it's a good starting point to say, hey, some people feel like we've come too far too fast. Well, history says that when we've seen this activity before, we tend to see gains going forward based on the Fed and based on the cycle. But then we have to layer on the economic outlook. We expect a modest uptick. We can go into more detail if you like on that. And then going back on top of that, so we have history on our side, the economic uptick. Valuations for this market are rich, but on the short term, on a 1 year basis, valuations don't have a big correlation with forward returns. Earnings are more important. We just discussed, we think those trends will remain resilient. And then lastly, on the technical side, the primary market trend is still positive. It has been somewhat uneven below the surface, but the primary trend is positive. And globally, more than 80% of markets that we track are in uptrend. So you put that all together, the weight of the evidence suggests there's still more room to go on the upside. But I certainly expect some curveballs and probably some scary periods or normal pullbacks that feel scary at times during the year.
Keith, you mentioned your economic outlook, so I'm curious to hear you walk us through that. There's some folks, Keith, I know, who have sort of thrown some yellow caution flags on the economy. I've heard analysis where they say, listen, it really seems to them like it's propped up right now by a relatively small group of wealthy consumers and data centers, and the foundation to them just looks kind of wobbly, but I'm curious to hear your take.
Sure, and I agree that we do have this two-speed economy. Some people call it a K. I think it's more of a two-speed economy. We're both moving forward at different paces. But so what's the foundation of our outlook? Why do we expect a modest uptick? It really comes down to four main factors. The one is there's going to be some tax relief, and we're likely to see that in the first quarter, both from the consumer side and from the business side. And that's because of the passage of that one big, beautiful bill last year where we got to actually see some of the benefits in the first quarter. So that's number one. Two, we do expect marginally lower rates from the Fed over time, so that should help ease lending rates. You mentioned already the CapEx spending. Collectively, that should continue to be at least a support for the overall market. And then lastly, tariffs aren't going away, but we expect some more stability. And remember, earlier this year, it was a shock when the tariffs came out. I think we've seen businesses adjust. So we put all those four factors together. That suggests to us we extend the cycle and move somewhat higher. And last point, Josh, if it's okay just for me to say, I do think the labor market is key. We have seen some weakness there, but we have 160 million people working. That's more important than the monthly jobs number. And we have to see wages stay above inflation. That's our base case, but that's also the risk that we'll be watching into the new year.
Finally, Keith, before I let you go, let's just bottom line this for investors. In terms of sectors I want to stay overweight, it looks like you're still a fan of technology and communications services, Keith. One, do I have that right? And two, if I do, why, Keith? What do you see in terms of valuations, earnings, policy that keeps you comfortable with that call?
Well, we've looked back at several different bull markets, and what we find is that every bull market has a dominant theme. This one is AI and tech, and the leadership of a bull market tends to last or endure until the end. So if we think we're still in a bull market, we want to stick with those. That doesn't mean there's not going to be some sharp rotations along the way, but that's why we're sticking with tech and communications. As I mentioned earlier, earnings are stronger. We did recently upgrade healthcare. It's underperformed by about 50% over the last 3 years. So I think that's a decent hedge. And you also want to have some modest exposure to small caps and mid caps so you don't have to try to chase these sharp rotations, which are likely to continue over the next year.
Keith, as always, great to see you. Thank you.
Thank you.
It was a push for a ban on Lawmaker stock trading is gaining momentum, and Yahoo Finance's Washington correspondent Ben Worschel joining us now with more. Ben.
Yeah, Josh. So the situation on Capitol Hill here in Washington is that two Republican lawmakers who have been pushing for a ban for months now, basically just ran out of patience, and they pulled the trigger on what's called a discharge petition, which is a maneuver to force a vote in the House of Representatives, no matter what the leadership wants. So that discharge petition was presented earlier this week. It's at its 16th co-signers right now, so it clearly has a long ways to go to get to the 218 number that's needed to force a vote. But it does have some significant early people that have adopted into it, especially on the Republican side. Elise Stefanik is a member of Mike Johnson's leadership team, and she signed on it. So this is clear momentum for this effort that we've been talking about for years to get lawmakers to and their families to be banned from trading individual stocks. The underlying bill here is called the Restore Trust in Congress Act, and it does have 104 co-sponsors in total, 82 Democrats, 22 Republicans. So there is a well of support here, assuming this discharge petition keeps moving forward. And it comes as, on the other side of the issue, Mike Johnson has emerged as an opponent here. He told Punchbowl News this week he wants to find a way for lawmakers to legally be able to own stocks, but there is a clear kind of revolt against Mike Johnson happening, and this discharge petition process has been remarkably successful this year. I just counted, there's been 10 discharge petitions so far this year. 8 of them have reached that 218 votes. So there is a kind of track record of success here. And this is the underlying premise of the advocates here, that public opinion is just so strong on the need for lawmakers to be banned from owning individual stocks. This bill does let you own widely held mutual funds, but trading individual stocks is just unacceptable in their view. And that the public opinion here, which by some measures is in the 80s in terms of people that want to ban, is going to force a vote to this eventually, sooner rather than later.
Ben, thank you. Appreciate it.
Right.
Coming up, we look at what growth in prediction markets can mean for big sports betting companies like DraftKings and FanDuel. That's next on Market Domination Overtime. Mortgage rates decreased for the second straight week compared to this time last year. Mortgage rates are 0.5% lower. Here with more, we got Yahoo Finance's Claire Boston. Claire.
Hi, Josh. So mortgage rates this week are at 6.19%. That is a slight decrease from 6.23% last week. And we have basically been in this low 6% space since October now, and we're really starting to see the effects of this on the market. We had a little bit more of a robust fall buying season than we would normally expect. And a lot of people I talk to say, rates are at their lowest point in roughly over a year. That was helping take some people off the sidelines.
What about mortgage rates next year? What's the forecast, Claire? What do the pros say?
Yeah, so we're kind of thinking probably around these levels as an average point for the next year. So 6.2, 6.3%. That is certainly better than this year, because in the first half of this year, rates were in the high sixes. And as a result, we averaged more like 6.6 this year. So, a little bit of green shoots, but absolutely not a 3% situation, which I think a lot of people wish.
Yeah.
But we'd have to have a recession to have that happen, and we don't want that.
What about home prices? What are the trends?
Yeah, so home prices are very interesting right now. We have around half the country where prices are continuing to rise quite a bit. And then in the other half of the country, particularly in the southeast and the Mountain West, prices are actually falling. So it's this weird bifurcated market right now. And that is also expected to continue next year. And so, it's really tough. It depends on where you are. But generally speaking, affordability may get a little bit better. But, for the first-time home buyers especially, it's still going to be really tough out there.
And finally, home sales have been brought back to life a bit. What do you see there?
Yeah, I think a lot of this is that mortgage rate story. 6.2% actually did help some people get back into the market. That being said, I don't think we really know how long this is going to continue. People are really rate sensitive now. But, since we have had rates at this low 6% level since October, maybe some of those people have already made their move and would need rates to go even lower, which we're just not sure is going to happen.
All right, Claire, thank you. As always, appreciate
Thanks,
it.
Josh.
Well, the betting market continues to grow with global sports platform Fanatics launching a prediction market platform, while prediction market Kalshi more than doubles its valuation since October. Here with more on the action in the competitive landscape, we got Jordan Bender, Senior Equity Research Analyst at Citizens. Jordan, great to see you, especially on set. Let's start there. So as that intro just referenced, you got a lot of news, a lot of headlines for prediction markets. Start big picture, Jordan. What are you seeing? What are you hearing in that space?
Thanks, Josh. Yeah, the pace that this industry is moving is incredible. It feels like every time I pick up my phone, there's some sort of news event, news story, partnership agreement with companies within this space. So, the pace that this is going, it's hard to keep up in a way. I was with a major online gambling company yesterday, and they said 99% of the questions that they're getting today are around the prediction market. So, this week alone, we've seen Polymarket relaunch in the US, we've seen Fanatics launch, and it's just getting going.
So, all right, so bottom line, you got a lot of news, a lot of action, a lot of headlines. If I'm an investor, I'm watching this right now, I'm thinking, all right, bottom line, who's going to win this? What do you tell clients?
It's a very complicated answer. I would say, from a...
You have plenty of time, Jordan. Take your time.
From a market share and a revenue perspective for sports contracts, our view is the traditional sports betting operators, DraftKings and FanDuel, they'll launch a prediction market platform in the next couple weeks. those guys have decades of experience. They know how to build the mousetrap. They have the balance sheet. They have basically the UI UX that they know true sports bettors want to play on. Now, I'm not writing off anyone else in the industry. There are other ways to win. We've seen Kalshi and CNN integrate odds. We've seen you guys integrate with Polymarket. So there are other derivatives and other ways revenue-wise to actually benefit from what's going on in this industry right now.
So FanDuel and DraftKings, by the way, and I know you like both names. You tell clients, I think they're both buy. But if I push you, Jordan, and we say, okay, if we make the bet, they're going to be winners in this space, is there one you would say against this environment, this backdrop, that's a strong buy?
It's funny, going back to the 99% of questions go in the prediction market, like underlying fundamentals within the other parts of this business are still incredibly strong. And I think a lot of people are kind of missing that point right now with the whole prediction market cloud overhanging, if you want to say that, over the industry. So from a true fundamental standpoint, we like both companies. We think both are actually set up well for traditional sports betting, iGaming, as well as prediction markets. But if we had to go with one, we do like Flutter for its global scale, its diversity, and its balance sheet.
Are there other, if we're talking about the prediction markets, are there other winners? Are there other derivative winners you would call out?
Yeah, like I mentioned, there's other ways to generate revenue because the data is key here, and that's what's going to be king going forward. You listen to what ICE, they invested $2 billion in the Poly market, and the reason was not sports contracts, was the data that they actually derive off of that. So if your viewers can now watch, or on any media platform, they can watch in real time and learn in real time people's opinions by real wagering, that's a benefit, and then that's also B2B revenue for companies like Kalshi, like Polymarket. So we think that there's a long runway ahead. I'd also point to, I was with clients earlier today, and one of the conversations was, if you're long a stock into a print and you want to hedge yourself very cheaply, you can go to the prediction markets and essentially say, they might miss earnings, and hedge yourself to the downside. So there's kind of different derivatives off of this industry that we think are ways to basically generate revenue for a lot of different companies.
What about, so I know we mentioned Flutter, DraftKings. I remember we spoke in the past, Genius is another name. Is that still on the buy list for you?
That's still a name that we like a lot.
How come, Jordan?
So they had an investor day yesterday. They exceeded kind of everyone's expectations in terms of financial targets. Just for reference, they have the data rights for the NFL. And it's a $3 billion market cap company. They have Roger Goodell get up on stage, commissioner of the NFL, and he's kind of saying how good this company is, what it does for the NFL, how it grows that game. So when you have the key infrastructure, the picks and shovels of the industry, like a Genius Sports in place, we think that's going to be a winner long term here.
Let's end here as we're looking at 2026 broadly. And you're talking about the sports betting market, the industry. What are the underlying themes and trends, Jordan? How just sort of healthy and resilient does it look as an industry?
Yeah. So going back to what I was saying earlier, the underlying fundamentals are still pretty strong. Now, there's been some bad game outcomes in the last couple of years. Sports bettors have been winning at a higher rate than normal. But as we look at sports betting, handle growth, the wagering still extremely strong. The pace of free money that they're giving out is starting to come down. So you're going to start to see that in higher growth rates for a company like FanDuel or parent company Flutter, which we like here. So underlying, sports betting strong, iCasino slots and tables on your phone, extremely strong. So those are going to be the winners long term, as long as these strong fundamentals continue in place.
Final question. We talk a lot about the macro on the show. And these concerns, Jordan, that are brought up about our labor market cooling, right, the K-shaped economy, how important is that to your coverage universe and the names we're talking about here? Yeah,
I'd say in the online names, it's a little bit different than if you say Vegas. You have to travel there. You need a big budget. This is, you might spend $5 on a given Sunday for an NFL game for 3 hours of entertainment. So we haven't gone through a recession since legalized gambling has been here in the US, but I would say, if you're spending a very low amount of money for that type of entertainment, it's going to be very resilient to what we're seeing in the economy. There's global instances of, during recessions, actually online gambling goes up. So I would expect that to be the same case here in the US.
Jordan, always great to see you, especially on set.
Appreciate it.
Thank you, my friend. All right, time now for What to Watch. Friday, December 5th. Starting off on the economy here, the Fed's preferred inflation gauge is coming out on Friday. That's personal consumption expenditures, or PCE. Economists forecasting total and core PCE, which takes out food and energy, remember, to hold steady at 0.3% and 0.2% respectively on a month-over-month basis, signaling that overall consumer prices are rising at the same pace as the previous month. Speaking of the consumer, we're going to be getting fresh data on Friday with December consumer sentiment. That number expected to come in at 52. That would be a small uptick compared to November, signaling that people feel slightly better about the economy than they did last month. Consumers may be a bit less pessimistic, but overall confidence, we know, is still low by historical standards. And taking a look at earnings, more earnings from the retail sector coming in on Friday with Victoria's Secret. Analysts expecting Victoria's Secret North America sales for the quarter to grow by about 1 to 3%. That's going to do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But don't go anywhere. On the other side of the break, it's asking for a trend. I've got you covered for the next half hour with the latest and greatest market-moving stories. Stay tuned.